Energy markets are flashing red again, just as artificial intelligence spending explodes, and equities are caught in the middle. This is vTalkInsight, Equity Pulse Daily for July 22, 2026. Let's unpack how that collision of energy risk, high yields, and AI Capex is reshaping today's equity backdrop. Global equities are still trading with a constructive bias, even though cross-asset signals look increasingly conflicted. The S&P 500 has just posted a gain of almost 1%, yet volatility remains in the mid to high teens, suggesting optimism with a layer of nervousness rather than outright complacency. In rates, the message is stability at high levels rather than relief. 10-year U.S. Treasury yields are holding around 4.5 to 4.6%, with 2-year yields near 4.2 and the long bond closer to 5, signaling persistent inflation concerns and no clear pivot from the Federal Reserve. Despite that backdrop, commentary still points to equities being favored over traditional bonds, helped by ongoing earnings growth and cheaper valuations relative to fixed income, where higher yields have eroded recent returns. Credit has been more defensive than stocks this year, participating less in rallies but offering more downside protection during risk-off episodes. The rate story is not purely American. In the UK, talk of looser fiscal rules, higher defense spending, and a lack of clarity on tax policy has pushed gilt yields higher and widened the spread versus German bonds, underlining how sensitive bond markets are to debt dynamics and policy credibility. At the same time, equity positioning among long-only investors is becoming stretched, approaching the exuberant levels seen in the 2021 reopening phase. With key U.S. growth tailwinds already realized in the first half and credit card data softening, several observers now see a non-trivial risk of a 5 to 10% equity pullback ahead of the U.S. midterm elections. The most immediate macro swing factor remains the energy shock centered on the Middle East. U.S. and Iranian military exchanges have persisted for a 10th straight day. Threats to the Red Sea and the Strait of Hormuz have escalated, and shipping traffic through Hormuz has nearly ground to a halt over the past couple of weeks. Brent crude has been oscillating around $90 a barrel, briefly dipping below as hopes for diplomatic intervention surface, but the risk premium is still evident. Several scenarios now point to a possible spike towards $120 later this year if maritime disruptions persist or the strait remains effectively closed. What is striking is that refined products look far tighter than crude itself. Global oil inventories are being drawn down aggressively, U.S. gasoline and diesel stocks are approaching low levels, and crack spreads and refining margins are at record seasonal highs, forcing prices higher to ration demand. U.S. refiners are benefiting from relatively cheap crude inputs and strong export and domestic demand, positioning them as clear winners in this turmoil, while other regions face affordability challenges and potential demand destruction. For airlines, higher fuel bills are painful in the short term but are also accelerating the push toward more fuel-efficient aircraft fleets. The other dominant force reshaping equities is the AI investment wave. Roughly 19% of the market is now linked to AI-related companies, and a small group of AI-focused names accounts for about 40% of the S&P 500, making overall index performance highly dependent on this single theme. Forecasts for hyperscaler spending are extraordinary, with projections of $5.8 trillion of AI capital expenditure over the next 4 years and rapid backlog growth for cloud providers. One study suggests U.S. data centers could consume 20% of national electricity by 2035, up from under 6% today, underscoring how AI is now an energy as well as a tech story. Yet leadership has become bumpier. The main semiconductor benchmark is on track for its worst relative underperformance versus the broader market in 25 years. The momentum factor has suffered one of its weakest months in a decade. Hedge funds are trimming tech exposure, and high-profile AI-themed listings such as SpaceX are trading below their IPO prices. Against that, recent price action shows how quickly sentiment can snap back when earnings deliver. Semiconductor stocks have just rallied more than 5% across the board, lifting the Nasdaq by almost 2%, while the Philadelphia Semiconductor Index logged its best day in a month, helped by strong demand signals and improving sector sentiment. Fundamentals remain powerful for key names. Micron and Nvidia are among the largest contributors to S&P 500 second quarter earnings growth. Excluding them, the blended growth rate would fall from roughly 25% to the high teens, and some chipmakers are reporting year-on-year earnings growth around 100%. Nvidia, despite underperforming peers by more than 50% so far this year, is now trading at its lowest forward multiple since 2019, while still dominating the GPU market and expected to double free cash flow by next year. Taiwan Semiconductor is reportedly preparing price increases of up to 10%, which has supported chip and AI-related stocks and underlines continued pricing power. On the platform side, large cloud providers look relatively insensitive to chip price hikes thanks to strong free cash flow and diverse funding channels, from bond markets to joint ventures. Google is improving AI efficiency with a new Flash model that uses fewer tokens, while controlling its own models, chips, and cloud infrastructure to manage costs and capacity. However, concerns are rising about potential overbuilding in AI infrastructure, drawing parallels to the underutilized fiber build-out of the 1990s, and a surge in AI and tech IPOs is expected to add more equity supply just as buybacks slow. With such high concentration in a single theme, upcoming earnings from hyperscalers, particularly Alphabet, and their capital spending plans have become crucial tests for sustaining the current tech-led rally. Outside tech, some of the clear signs of real economy momentum are coming from the banking system. Commercial and industrial loan growth at U.S. banks has accelerated to double-digit rates, the strongest in more than 3 years, driven in part by AI-related capital investment and reshoring projects. That backdrop is feeding directly into financial equities. The financial sector has outperformed the S&P 500 by nearly 600 basis points over the past month, helped by record issuance, expanding margins, and strong results from names such as Capital One, which delivered a 27% year-on-year revenue increase and better than expected earnings per share. Credit markets remain broadly stable and continue to offer attractive yields, but with greater dispersion beneath the surface. Since late 2021, high-yield bonds have returned more than 20% and leveraged loans over 30%, while investment grade has been flat and private credit still offers yields above treasuries, though non-accrual rates for some business development companies are climbing toward 8%. Strategists at Goldman Sachs are highlighting this regime shift by advocating larger allocations to real assets and gold, signaling waning confidence in the traditional 60-40 mix of stocks and bonds. For equities, that combination of supportive credit, high but stable yields, and good earnings argues for a still positive, but more finely balanced, risk-reward profile. At the single stock level, autos are sending a surprisingly upbeat signal. General Motors has raised its full-year profit outlook by $500 million, delivered record first-half earnings per share, restored North American margins to the 8 to 10% range despite roughly $3 billion of tariff and inflation headwinds, and still trades at less than 6 times projected 2026 earnings. Higher oil prices are also reshaping aerospace and defense. GE Aerospace has secured more than 1,000 engine orders from Indigo in India, pushing its backlog into the early 2030s and lifting engine deliveries by over 30% year-on-year as airlines prioritize fuel-efficient aircraft to offset rising fuel costs. In defense, the UK is signaling a move to increase military spending from around 2.7% toward potentially 3.5% of GDP by 2030, which would benefit programs such as the Global Combat Air Program and Rotary Wing Autonomy, if fully delivered. Lockheed Martin is expanding local F-35 and missile production in Europe, and Northrop Grumman has a record $105 billion backlog, although investors remain cautious about execution and the durability of this demand. Healthcare and consumer stories highlight how idiosyncratic risks can move stocks even in a strong macro tape. Novo Nordisk and Eli Lilly are locked in a legal and commercial battle over obesity drug advertising and real-world efficacy, with reports that higher-dose Wegovy uptake is limited by side effects, implying that adoption curves may be slower and noisier than headline trial data suggest. On the consumer side, Hasbro's Magic. The Gathering franchise has just delivered more than $500 million of quarterly revenue for the first time, while the company's licensing business generates $700 to $750 million of operating profit at margins above 60%, tapping into the so-called gilt collectibles trend. Media is facing a very different tone. Paramount's proposed $110 billion takeover of Warner Brothers has been hit with a temporary injunction and mounting legal challenges from U.S. states, bringing ticking fees that could reach $600 million per quarter and a potential $7 billion break fee if the deal collapses, and signaling tougher scrutiny for large media mergers across the sector. Pulling this together, equities are trading between two powerful forces: a tightening energy backdrop and persistently high yields on one side, and an unprecedented AI-driven Capex and earnings boom on the other. Energy markets, credit conditions, and government bond curves are all flashing that inflation and policy risks are not behind us. At the same time, financials, select industrials, autos, and parts of healthcare and consumer discretionary are delivering strong micro-level stories that help broaden market leadership beyond the largest AI winners, even as concentration and positioning risks build. From here, the key signals to watch are Middle East shipping and oil inventories, the path of US and UK yields, upcoming hyperscaler earnings and Capex guidance, and any cracks in credit quality as loan growth accelerates. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.